Having discussed the purchasing power of money, inflation, investment, and risk, now we come to something called as liquidity. Liquidity is one of the most simple and one of the most important aspects of finance. But unfortunately, it is also one of the most neglected or ignored part of finance when we discuss about investment. So what is this liquidity? Let me explain by asking you, have you ever tried to pour water from a bottle into a glass, or for that matter, wine from a bottle into a glass? You will be able to pour out till the last drop and with ease. But try doing the same thing with a bottle of sauce. Though the entire bottle of sauce may belong to you, you will not be able to take out everything from that. And even if you try to take out, it will not be very easy. And that explains liquidity. Liquidity is nothing but how easily you can convert your own assets into money. Say, for example, you have cash in your bank. Say you have about $50,000 or rupees or reals or nairas or whatever currency depending on which country you are in. Say you have your amount in a bank, in your savings bank account, and if you want to use a small portion of that, what you do is you just go to the market, buy whatever you want, and you swipe your card and the thing is done. So it is as simple as that. Therefore, your cash in the bank is considered to be absolutely liquid. But suppose if you have invested your money in, say, fixed deposits or bonds or debentures, now these instruments normally have a maturity period, a predefined maturity period. Say, for example, if you have put your money in a fixed deposit, it may be for a period of 1 year, 2 years, or 5 years, or whatever. And therefore, if you require that money before that maturity period in an hour of urgency, then that money may not be easily available to you. You may have to go through a process to liquidate that asset and convert it into your cash. And maybe you may be required to pay some fine or maybe some penalty for premature withdrawal. Therefore, such instruments are not considered very liquid. Now suppose if you have invested your money in stocks or mutual funds or shares of some good blue chip companies. In such case, when you require the money, since they are in the electronic form, you just have to press a couple of buttons on your computer, and in a day or two that money will come back into your account. Therefore, such assets are also considered as liquid. Another example is gold. Now, gold in banking terms is considered to be absolutely liquid. But when you are holding gold as your personal asset, maybe in the form of coins or small biscuits or brick or whatever you call it, in that case it may not be very liquid. If you require to spend a small portion of that, then you may have to go to the market, convert that gold into cash, and only then you will be able to use it. And especially if you have kept gold in the form of jewelry or ornaments, then you may not get the entire value out of it. Therefore, gold as a personal asset is not considered to be very liquid. But yes, nowadays gold is also available in the form of ETF, or what is called as exchange traded funds. Now, if you have gold in the form of exchange traded funds, which is in the electronic form, then it is considered as liquid, because again, like stocks and shares, you just have to press a couple of buttons on your computer and the money comes back into your account. Now, another aspect you consider, suppose you have invested your large chunk of money in some real estate or property. In that case, when you require a small portion of that money or even the entire money, then it may not be very easy for you to get the money back at short notice. You may have to go through the process of sale, which may take, maybe a couple of weeks or maybe months, depending upon in which prime location you have your property. So holding your money in property is not considered to be liquid. And therefore, the point which I'm trying to convey here is that whenever you invest your money, you must distribute that money into different assets, giving due importance to liquidity. You may require to invest some portion in absolutely liquid assets, maybe some portion in semi-liquid assets, and maybe some portion you can invest for a long term in little more illiquid assets. Now, liquidity has got one more aspect. If I may say it, in a different manner, liquidity has got two aspects. One is what I have just told you, the liquidity of your personal assets. And the second is how easily and how much money is available in the overall economy. Now, this aspect of liquidity, which concerns the overall economy, we shall discuss in detail in the next lesson.